Good morning. Faya, good to see you. Adriana, nice to have you back. Ron C, here comes Trouble. Joe C, good to see you. Pete, Aaron, and Jen. We've got all the cool kids in the exact same room. I love that. How are you guys doing today? Everybody hear me okay? Am I coming through loud and clear? I hope so. Hey, good afternoon, Miss Jen. Pete, great to have you. Um, gonna be a good day. I just have a feeling it's gonna be a good day. I'm excited. Um, Before we get the day going, let's just check news while people funnel in. Today is, what is today? Today is Tuesday, April 22nd. And we've got FOMC members talking, but apparently nobody's worried about what they're saying. But at 10 a.m., we do have some medium impact, the Richmond Manufacturing Index. Two types of news that we look out for every morning, or that I look out for every morning. The red box is the high impact news. I have zero desire to be anywhere near the market. The medium impact news, if I'm in a position, I'll make sure that I've got room to protect myself. If I don't, I'll choose to exit. So the forexfactory.com/calendar, this is our first stop every day. Just want to make sure that there's not shenanigans that could make the market untradeable. And one of the things I want to talk about is when I say make the market untradeable, I'm referring to speed, guys. The orders flow in so much that sometimes it's difficult to keep up, and it's better to sit on the sidelines. I was having a conversation with someone this morning, yesterday, I don't know, during volatility, like when it's crazy fast and too fast to trade. If you scroll back and you look at your market and you compare it to the patterns that we talk about every day in this room, what you'll find is that even in times of just manic panic, the patterns still hold true, guys. So we're going to focus on patterns today. Good morning, Cav. We're not going to focus on money. We're going to focus on patterns. We're going to focus on a process. We're going to focus on things that are repeatable. And the pattern that I'm going to talk about is what we call a high probability trend trade. And a high probability trend trade, it simply means that each rule on every chart is met for the trade. Each indicator agrees. And the high probability trend trade, you can find all of it from the Nexgen page right under the trading plan. This goes through how to identify that trade step by step. I'm going to do that with you this morning. We're really going to, I guess, do the same thing we did yesterday and the same thing that I'm going to do tomorrow. Because one of the things that I've found is that repetition creates recognition. The more you hear something, the more you see something, the more likely you are to retain it, to create that little neural connection, and trading becomes easier. And chart reading becomes easier. And guys, with this high probability trend trade, chart reading is the goal. That's exactly what that trade's going to do for you, is it's going to teach you to read your indicators. The high probability trend trade, as taught, is 3 rules on 2 charts, and it's nothing more than a pattern. It's a description of a pattern, and that pattern has been proven to win more than it loses, and you'll have the potential to win up to 70 to 80% of the time with this particular pattern. That win percentage creates confidence. They say that confidence comes through the memory of success. I believe that 100%. When things are going well, the human brain wants to continue that path. When things are going poorly, that's when panic starts. So we're going to focus on the pattern, and you're going to realize that waiting for this pattern to materialize, waiting for your patterns to materialize, for your rules to be met, is about 90% of your day. There's a lot of waiting in day trading. There's a lot of doing nothing in day trading. There's a lot of patience required for day trading. But 10% of your day will be actively trading, and trading because your rules are met. And once you focus on chart reading a little bit, when you begin to focus on the process, the recognition of advantages, you're going to walk away from that study with the ability to understand where the market is most likely to continue. That's going to become entries for your high probability trend trade and probably a lot of trades after. You're going to understand where the market is likely to go. This is going to help you with targets. And then finally, you're going to understand where the market is likely to stop. And you're going to see these areas, and you're going to know that they can stop your forward progress, and then you're going to have to make the decision to not trade into them. The high probability trend trade, guys, this is the best of the best, I'm going to say. And again, it's only 3 rules. And each rule, when they're met, is creating an advantage. So the recipe for a trade isn't, I need to pay rent, or the recipe for a trade isn't, I want to make $1 million, or I want to buy a diamond ring. The recipe for a trade is taking 3 advantages and piecing them together, and understanding that it's a description of a pattern that's been proven to win more than it loses. And it's not just a pattern that we saw one day and said, okay, let's turn this into a trading plan. This pattern is testable, it's repeatable, it's verifiable, guys. And what you'll find is that the most successful traders do the exact same thing each and every day. The people that find the highest level of success have the least amount of deviation from their plan. So we're going to focus and keep it pretty rigid in the beginning. We're going to let the large chart have strong triggers because that provides the advantage of momentum. And we're going to let the large chart define our termination conditions. Those are those likely to stop the market areas because we want to make sure that we have a clear path, and that happens only when there's none present. And then finally, we're going to define our entry. We're going to pinpoint precisely where the market is most likely to continue. These 3 rules happen on only 2 charts. There's a large chart. It's a slow chart. It's a very broad stroke of a brush. It's difficult to see change on this large chart, but it shows the overall opinion of the market. And by using the very first bar, you'll get enough information to define the direction of the market and know which direction you should be trading to have the highest advantage. You'll be able to define the momentum in the markets using rule number 1, looking for those strong trigger lines. And you'll be able to determine and verify that you do in fact have a clear path, that there are no termination conditions in your way. And all of this happens inside of one big slow moving bar. Once the rules are met, and I like to say only when the rules are met, am I going to the smaller, faster chart? And on the smaller, faster chart, you're going to refine that broad stroke of a brush. You're going to be able to take that little group of advantages inside of the 1 bar and turn this 1 bar into 20 to 30 bars by using a little bit smaller time frame. That refinement process is what you're going to use to pinpoint the best of the best entry. It's going to allow you to reduce your risk, and it's going to help you maximize your profit potential. And that's where rule number 3 comes from. Rule number 3 comes into play only when the large chart says go pull the trigger. 2 charts, 2 groups. Hey, good morning, AFLabs. Great to have you in here again. I want you this is the easiest way to do it. The large chart is the big crowd. You'll never have the power, the influence, the money the big crowd has. These are the institutional traders. Let them define the direction, let them create the momentum, let them react to the key areas, and then you just kind of hang out with them and do what they do. Your small chart is the small crowd, and these are your fighters. These are your ne'er-do-wellers. And they create little down pushes when the large chart wants to go up, or little up pushes when the large chart wants to go down. And this fight from the small crowd, from the small chart, is exactly how we get to the best of the best entry, because rule number 3 is designed to show you exactly where the small crowd is most likely to fail. And the great news is that they typically fail 70 to 80% of the time, which means up to 70 to 80% of the time, you're going to have the potential to win, entering at their failure point. My classroom is consistent daily. The first hour is very much like a lecture. I know that. And some of you are thinking to yourself, gosh, I don't want to hear this. I've already heard this twice. Hear it 200 times, and what you'll find is that it sticks and it clicks, and that repetition creates all the recognition that you need. We spent an entire hour, for the most part, learning the trigger line and the Fibonacci rules for when it's okay to trade. When I say it's okay to trade, in my mind, what I'm saying is that my rules are met. Because my rules have been proven, they've been verified, I've studied them, I've gone back and tested them, and I've made sure that my rules win more than they lose. So the only reason I ever want to get into a trade is because I have the advantage, I have an edge. I have a predictable, repeatable pattern that gives me the advantage that I'm looking for. You guys have the ability to simulate, to practice, to get in there, and hopefully very willing to make mistakes. I love mistakes on Simulator because what it does is it lets you know where your brain's at. It lets you know what you're doing and how you're doing it. And if there's something that needs to be fixed, the magic of this room, guys, is all you have to do is post it in the room and tell me what you saw and tell me what you did, and we'll work through it. We'll talk about your chart read. You'll tell me about the momentum, and you'll describe your path, whether it was clear or not. And you'll show me where you enter, and you'll show me where you exit. And I'm going to tell you right now, guys, if you omit this step in the process, it will take you longer. If you don't write on your chart and tell me what you saw, how am I ever going to help you learn to read your indicators? So take the time to type. This is how we're going to have a conversation. Discuss the 3 advantages. If you choose to not trade with all 3 advantages, if you choose to trade into a termination condition, if you decide to trade without momentum, guys, write it on your chart and give me a why. I chose to trade into a termination condition. Why? Why would you trade without that advantage? And very often it's because I was bored. And if you write that on your chart, you're going to find that you get bored a lot as a day trader, and you're going to have to learn to overcome that. But when you write the whys, especially for the good, you're creating this recipe, this hey, I had momentum, my path was clear, I defined my entry, that's why I took this trade, because this is the pattern that wins more than it loses. You're writing the recipe, you're creating a description to go with the look, and all you're doing is you're creating pattern recognition. If it's the wrong trade, when you write the whys on there, what happens is you begin to identify the challenges that need a little help. If you're breaking rules, if you're making mistakes, writing why you took that trade helps me identify. And it gives me a basis to go through and work with you to fix any mistakes and help you overcome any challenges. So don't ignore posting in the room, guys. The people that post the most, without a doubt, get to where they want to be the fastest. We're going to simplify. I'm going to give you 2 trades and a trading plan. It will define entries very precisely. It will teach you how to manage that particular trade. Your job is going to be to learn what looks you'll commit to. The easiest way, the fastest way to learn this software is to not look for trades, to not look for the money, but rather learn how to find the advantages. Learn how to recognize momentum, get good at it, let it be instantaneous, and then once you've got that lesson, begin to learn and recognize the clear path. I'm going to teach you how to do this, and I'm going to give you a recipe for how you identify it. And once you have momentum and clear path, and once you can see these 2 advantages clearly, you really do have everything that you need to be successful with the software. You can create a plan based on nothing more than momentum and a clear path, and find an unprecedented level of success. You're going to see it in this room. Rule number 3 is nothing more than a trend trade entry. So by learning this entry, and the reason that we talk about it in the beginning is when you understand where the market is most likely to continue, you're defining where the market shouldn't go. And this lesson from the highest probability trend trade that we give is gonna really pay dividends in management lessons later on. So I am going to hand you a plan. We're going to talk about each rule. We're going to break it down. I'm going to give you everything that you need to study it. And one of the things I'm going to give you is this spreadsheet. And this is the second part to becoming a confident trader ASAP. I dropped it in the room for you just now. There's 4 tabs. The first tab is the rules being met here in green. It's just a picture. We did some yesterday together. I'm going to show you. If you go to the strong trigger section, rule number 1, It's a description of what it means to have strong triggers, what it means to you in terms of advantages, and it's arrows pointing to exactly what it looks like to have that rule met. I will give you a sheet that's going to be a study tool for you to learn these rules individually so that you can piece them together to create a trade. So you've got strong triggers, and then you need to know what it looks like to have your advantage gone so that you can sit on your hands and do nothing. And then you're going to look for the clear path, and it's clearly defined. And you also have to know what it looks like to not have a clear path, so you know to be patient, to wait. There's a little bit on defining entries too, guys. So the trade isn't your desire to win. Remember that. The trade is the accumulation of 3 advantages, and that's what creates the trade. The green section on the client trade section is you guys doing wonderful things, learning how to enter, exit, all the good stuff. I see somebody sending me a message. Guys, I completely always want to be your friends and get your messages. Good morning, Faya. Just remember, I don't typically see them until breaks or something, so I don't ever want you to think I'm ignoring you. This is the high probability trend trade entry, both long and short, and this is just breaking down that entry pattern to get you into the market where the market is most likely to continue. About 500 pictures of you guys taking high probability trend trades, medium probability trades, the 2 trades from the plan that I'm going to give you. So this becomes a little bit of a study guide where you can look at it, where you can almost critique yourself, these pictures, looking for those advantages, seeing that when they're present, that it tends to be easier to win, and then some ideas on management. And this is a great way to begin your trading plan. And then the next tab is your plan. This is your personal trading plan. And I realize that I don't cover this as much as I should, so I put together something today. When we talk about a trading plan, a trading plan is, this is AI, so the words are big, is a comprehensive framework, guys. It outlines your goals, your strategies, your risk management. It's an evaluation methods for your trading activities. It's a systematic approach that helps you decide what to trade, when to trade, how to trade, ensuring consistency and discipline. Traders who win consistently treat trading as a business, guys. Create your trading plan based on a business plan. And what it does is it acts as a blueprint in your decision making. And when you have a trading plan built, you're saying to yourself, my highest chance of success comes from this. This is what I'm going to pursue. And I will give you a solid trading plan. But understand that you will ultimately build your own. And one of the greatest quotes that I've dropped in the room earlier is you need to have a physical copy of your plan, guys. There's no such thing as a successful mental trading plan. You need to write it down. It needs to be repeatable. Hey, Marky Mark. The final tab is the trade tracking section, guys. And this is where you're going to take the pictures that you've posted in the room of your trades. And Adriana, you're getting put on the spot here. So if you post in the room and you show me a bunch of charts and you're not sure, like why did you take the trade? What about this chart, your large chart, said that it was time to look for an entry? Why did you get in over here? Entry at the area, well, I can see that. You know that you did, but why? Third divergence, don't want to be there no more. Termination condition, you take the exit. But the one thing that's missing from this is, and I would say, why? Why on the large chart did you look for the entry? And if you can't answer it, well then it's going to be difficult to take a trading plan. And here we go. What does this chart do for you? So Adriana, I don't need you to tell me, right? Because I can look at your chart and understand. How are you going to repeat this? But Adriana, you had a fib at 36, you have a fib at 36, and you don't have a clear path. Not at all. It's straddling a fib that could stop the market, a fib that could create an untradeable bounce. Wouldn't you agree, Adriana? So if you write clear path on there, I say, Adriana, let's review the rules for a clear path. Your clear path isn't present until small and large triggers get above resistance. And then your path is clear. And then you have a higher chance buying that fib, and you're less likely to get run over. Does that make sense, Adriana? By letting the triggers clear, now the path is clear. And this would be a lower risk entry, a higher probability entry with that clear path. And I'm only using you for an example here because, Adriana, now if you write the whys, what you've done is you've said, this is exactly what it takes to get me in the market, and I can do the exact same thing every day, and I can prove that it wins more than it loses. And that's how you guys are going to build your trading plan. And then over here, if you drop it in here, you're going to say, area not broken until triggers clear. I need to be a little patient. If you accept the feedback. And Adrian, I'm not beating you up. I'm trying to do a lesson on why posting in the room, getting the feedback, but then most importantly, coming back and filling out a spreadsheet, because every morning you should come back and look at what you did yesterday. So Adriana, when you look at this picture tomorrow and you're saying enter at the area, right? But why did you enter at the area? You're developing a trading plan so that you can do the same thing every time. I hope that makes sense, and I hope that doesn't feel like I'm beating you up. But what happens, guys, you're going to start to ask yourself what worked and what didn't work. And you're going to see patterns that are bringing you success, and you're going to see patterns that are taking them away. And as you grow outside of the trading plan, Ron, I have no idea what that white line is. It's an albino fib. I don't know. I'm sorry. I don't know what it is. Hit control. Not even control. Ron, click on your chart and hit head 5. Have it rerun the ninja script and see if it goes away. I'm not sure. I've never seen the white line like that. So guys, you're going to come back and you're going to use that spreadsheet and you're going to ask yourself what's working, what isn't working, what was the feedback, and it's going to set you up. As you come into the day, you're going to be focused on those advantages that get you into the trade. And you're going to be focused on those things that are going to keep you out of the higher risk trades, the less likely to win trades. Because remember, trading is just following patterns. That's all it is. That's the pirate line, arg. So the path to becoming a trader has been consistent for the nearly 30 years that Nexgen has been teaching people. Get feedback. Post in the room. Get feedback on everything you do. You can't post too much. The only thing that I ask is that if you post in the room, this is a training room. This is an educational room. Post why. Tell me why you did what you did, and let's turn it into a lesson. And then use the spreadsheet, guys. The more pictures you take, the faster you're going to get to where you want to be. The more pictures you take, the quicker you're going to recognize this pattern. The easier it becomes to see this pattern. And honestly, the faster you begin to recognize patterns outside of this very basic plan. So we're going to learn the rules. You guys practice post in the room. Let me give you feedback. I'm going to hand you a plan with 2 trades on it. Your job's going to be to learn those looks. You're going to learn those advantages. You're going to piece them together. You're going to commit them to memory. And in order to learn this pattern, in order to learn this trade, you have to know what you're looking at. So we're going to start with indicators. There are small triggers, solid lines. They're a fast-moving average. 2 solid lines working together create the small triggers. And there are large triggers. And the large triggers are the dashed lines, and they're a slower moving average. And when they're green, they're going up, and when they're red, they're going down. And that's really all you need to know about trigger lines. Trigger lines will be used to define momentum primarily. That's going to be their first role, making sure that rule number 1 is met. Trigger lines will be used to define termination conditions, making sure that you have that clear path. And then the large trigger lines will be used to define your entries. So trigger lines work their way into all 3 rules, and the only thing that you need to know is that these are small and these are large. Both charts will have areas. They're the same areas, they're just from different time frames. Each area has a name, and divergence highs are a magenta line. These will print if there's a loss of momentum right at this pivot, which means that everything is going up, and when the market goes down a few bars, the software goes, whoa, here's a momentum indicator that says momentum isn't following price. That slowdown is visualized in a magenta line. You see it as a cyan line from a low. You'll see red Fibonacci resistance, and when the market is trending up on the large chart, this is a point that could create a bounce, could reverse the market. Fibonacci support is the blue line, has the exact same role. You'll see yellow 1-to-1s. In an uptrend on the large chart, it may behave as resistance. In a downtrend, it may behave as support. And then the midband kind of wiggles its way through everything. On the large chart, these areas are where that large crowd are making decisions. These are areas that could stop the market, create big untradeable bounces. On the small chart, we're going to use them for entries. And the only thing you need to know is the names. So we're going to start with the rules. Rule number 1. Large chart, big chart, slow chart, large crowd, however you need to say it, must have strong trigger lines. Because the first advantage is the first advantage for a reason, guys. It's momentum. Momentum is amazing. And the only way you can have that momentum, those strong triggers, is to be trading with the trend. So if the market's going up, the background's going to be green. There's those colors again. If the market's going down, the background is going to be red. It doesn't mean jump into the market because it's going up. It means look for your rules to be met, to go with the trend, to trade with the large crowd. Strong triggers in an uptrend means, let's take a picture and have some fun. Strong triggers in an uptrend. Both small and large triggers must be green. So all 3 colors match, large, small, and background. And then it's the separation between the small and the large. So the small triggers will be up and above the large triggers. The large triggers need to be wide, angled in the direction of the trend. There is no strength in flat triggers. And then guys, I want you to picture scissors. And when scissors are open, you have the ability to cut, to get work done, to make things happen. So the separation between the small and the large, that's your strong trigger look. In a downtrend, smalls are below the large are wide. And then once again, when those scissors are open, when there is separation between the small and large, guys, that is your strong trigger look. So strong triggers provide the advantage of momentum. Because when I have strong triggers, the odds are favorable for the market to continue in the direction of the trend. And you're going to hear that all day long in my room. Odds favorable momentum. You're going to see it annotated on charts as OFM. And guys, when you have strong triggers, the market pushes. It's very difficult to stop. When you have strong triggers, that's what we look for to say those key Fibonacci areas have the potential to break. When you have strong triggers, guys, this is something that can even cover some of the mistakes that new users make. But I want you to see, eventually, those strong triggers, they weaken and the scissors close. And guys, when scissors close, you can't cut. You can take a stab at it, but you can't cut. You can't get the work done. So as a brand new user, I want you to keep it very black and white. Let it be strength, guys. Strength sets the tone. It's difficult to stop. Weakness, the phrase we use as opposed to odds favorable is anything could happen. Anything could happen up or down with weak triggers. When you have weak triggers, that's when key Fibonacci areas are more likely to hold. When you have weak triggers, that's where retracements tend to come from the middle of nowhere. And I'm going to go to a large chart here. And we're going to open this up real quick. This is crude oil. And we're not going to worry about a trade. We're going to look for strong triggers. And we're going to use that recipe to define them. Strong triggers means that the smalls are above the large, that there is space, and that strength pushes the market and actually breaks that area. And then strong triggers down, the separation. And strong triggers down, the separation. And guys, it's an easy look. It's a black or white look. It either is or it is not. And you'll notice here with weakness, you get a big retracement. And you'll notice that Where'd it go? The colors don't match. One's red, one's green. You don't have momentum. And guys, this is rule number one. Is everybody good with that? Everybody's okay with the idea that momentum leads the way, that momentum pushes a market, that momentum can cover mistakes. And guys, when you have momentum, it's time to go to rule number two. I take pictures every now and then, and I think they're funny. This is odds favorable momentum, guys. This is odds favorable momentum. And this is what you should think of it. You should see a big semi. You should see the idea of something that's difficult to stop. And when you see weak triggers, there's your weak triggers, little smart car. It's not going to get anything done, right? Maybe 18 clowns pop out of it. It's one of my favorite phrases, Pete. And then the reminder that no matter how much you wish this little guy was odds favorable momentum, it's just weak. No matter how you try to sell it, it'll never be this guy. So get the visual. Strong triggers push a market, guys. And then once I have it, I have to make sure there's nothing in the way. I have to make sure there's no brick walls, no areas that could stop my forward progress. And that means that termination conditions are false. That's going to give me room to my profit targets. We're just going to call it a clear path. This is your second advantage. This is the second of the core advantages, because if you have a market that is absolutely screaming in the direction of the trend, termination conditions can stop it no matter how strong the momentum is. So what is a termination condition? Guys, it's a Fibonacci-based indicator that can stop the market. It's a Fibonacci-based indicator that could create an untradeable bounce. It's a Fibonacci-based indicator that could set off a fight, because these horizontal lines on the large chart, this is where decisions are made by the people that are making decisions, the people that are in control. And we use that concept to define termination conditions. So I'm going to give you the two-part recipe, guys. Awesome. Adriana, have a great day. It's a two-part process to define a termination condition. The first thing is we let price reach the area. We let the large crowd reach the area in question. So if the market is trending up, the triggers are up, the price bars are up, and price reaches resistance, we are now done with price. Price arriving at the area is what sets off the decision-making process. Your trigger lines will let you know if it's a termination condition. So when price reaches resistance, I want you guys to ask, where are my triggers? And if your triggers remain below, it's a termination condition, and it may reverse the market. And it may create a fight between buyers and sellers that you don't want to be a part of. It may break, they break all the time, or that key area could reverse the market completely. And if a termination condition reverses the market, meaning those large triggers go from green to red, this is what we call a strong top. A strong top is the precursor to the highest probability trend trade you could ever take. A strong top is rule number one for the second trade on your trading plan. A strong top is rule number one for an HVA trade, for a momentum trade, for just almost every trade. Because when the decisions made are so impactful that a market reverses, larger moves the other direction are more likely to happen. And then going the other direction, price comes down and it reaches Fibonacci support. No, because Mighty Max, you don't even know it's a strong top until it reverses the market. So look at this. There's your termination condition. And then there is 1, 2, 3 bars later until those triggers finally roll. So you're all the way down here by the time it's a strong top. But what happens, Mighty Max, is if this strong top reverses these triggers and gives you this momentum, Mighty Max, you're going to be able to pinpoint if the market gives you an entry, and then that entry becomes one of the best of the best. Does that make sense? Not a good point of entry, because when price reaches that fib, and let me show you a good example of that. Price could reach that Fibonacci area, and look at the momentum, Max. Do you see it? It is screaming down. I don't want to fight that. I don't want to fight strong triggers. But with a little bit of patience, that reversal comes and there's some opportunities in there. So what it does is it doesn't define your entry as much as it creates this solid anchor and a good feeling and warm fuzzies on whatever trade you take after that strong top. Does that make sense? One of the great things about what we do is, guys, we don't have to be first. We don't have to be in at the fib. We don't have to be holding trades all the way until the fib. The easiest money is made in between Fibonacci areas using momentum. And guys, this is where trading becomes effortless. And if that market comes all the way down to Fibonacci support and price reaches support, we are done with price. Price no longer has a bearing on whether or not the area is broken or whether it's a termination. The trigger lines will tell the story. So I need you to ask yourself, where are my triggers? And if your triggers remain above support, support's a termination condition. And once again, it could bounce, it could fight, it could break, it could reverse. You'll never know what's going to happen. If it reverses, it's a strong bottom. Because your highest chance of success comes from doing absolutely nothing into the area that has been deemed a termination condition. Because termination conditions weren't defined in a day. Termination conditions were defined over the course of studying thousands of pictures. In using that exact recipe, if price reaches the area and the triggers don't break, is it more likely to ruin the position or create an advantage? And guys, when you reach an area and the triggers don't break, it's more likely to take your money than provide money, which is how the rule came to be. But they do break. But I want to ask, is everybody good with that? If price reaches the area, number one here, and the trigger lines remain below resistance, it's okay to do nothing. It's all right to wait for the reaction, to see what the large crowd wants to do instead of trying to predict what they want to do. If it's going to break, it takes a minute because trigger lines will define it. So an area is considered broken once your small triggers and large triggers, both lines of each, when they get through that area, now resistance is broken. It becomes support. And your path is clear. And your path remains clear until the next area is reached. And then once you reach the next area, guess what? We start over. It becomes a termination condition again. So again, let it be very black and white in the beginning. Learn to identify a termination condition. Learn that recipe. Price reaches, where are my triggers? And then to define it as a clear path, both small and large triggers get above the area of resistance. Resistance is now support. My path is clear until I reach the next area. And that's the very black and white for the new users. But recognition of that, understanding that, using those rules, it opens the door for the second trade on your plan. And this is what we call a 50-50 trade. And a 50-50 trade is not a high probability trade. It's what we call a medium probability trade. And a medium probability trade is defined as most of your indicators line up for the rules for the trade, meaning that you will have momentum and you'll have to define your entry area, but because only the small triggers, 50% of your triggers, have made it above resistance, and 50% of your triggers, the large triggers, are still below resistance. This look, this 50-50 look, pretty clever, right? You could call it a straddle look or a one above, one below look, whatever makes you happy. But this look, as long as the scissors are open, as long as I have momentum, this is the look that lets me know that area has the potential to break. But it's not broken yet, it's only potential, which means that if I take a trade, and you'll take a lot of trades like this, it means that you have to manage it a little more assertively because you have to understand through the recognition of advantages that it is in fact only potential and not a clear path. So going the other way, price reaches support, triggers remain above. Let's wait for the reaction. I got you right now. And then, boom. There you go, Jen. Did that help? First, it's a termination. It's okay to do nothing. Then it has the potential to break. Let's manage it assertively if you find an opportunity. And once it's a clear path, guys, enjoy that clear path, especially with momentum. And you're going to enjoy that clear path until you reach the next area, at which point it all starts over. Which comes to my next point. There will be times when your path isn't clear because areas are stacked a bit. You might go from termination and you'll say, yes, it has the potential, but dang it, I hit another line and my triggers haven't broken. It's another termination. And then you've got the potential on that line and you're excited and they hit a divergence low and you're like, son of a gun. That's 3 termination conditions in a row. 3 times where I didn't get the opportunity to do anything. And guys, this is 90% of your day. 90% of your day is sitting on your hands doing nothing. 90% of your day is wishing you had odds favorable momentum and a clear path. But that's okay, because the futures markets typically trade billions. I looked it up yesterday. So the S&P, US S&P traders, typically trades $173 million a day. $173 million is exchanged in the S&P futures daily. You don't have to be in every trade. And Mighty Max, this goes back to, you don't have to be the first one in. And you don't have to be the last one out. Guys, if you can take a couple little chunks when the conditions are perfect, when the large crowd sets you up for success, it only takes $400 a day to put yourself in a 6-figure income based on your trading. That's it. $400 a day. 6 figures. You don't have to be in every move. So let's go to a large chart and let's just see if termination conditions work. Whoops, sorry. And I'll backpedal a little bit. I just want you guys to see this. This was right before the holiday. Can you guys give me a Y if you can hear me, please? So one with, one without. Anyone else? Can you hear me? F5? Okay. So let me type this in real quick. If you can't hear me, it's on your end. Please reboot. Because if you guys can hear me, if any of you can hear me, all good. Thanks, 10K. Bob, you lost everything. Follow your rules. Just kidding. That was kind of a trading joke. Here, guys, I'm going to do a little reboot. If you get bumped, please come back. And for you YouTubers, I apologize. We're going to get back to where we want to be here in just 1 second. All right, guys, can you hear me? Are we good? We gonna make it? What do you think? Yep, 10K. 10K, you were good before. Bob's back. Love it. Awesome. Perfect, guys. I want you to see this. And this is pretty awesome. And I'm going to use the stamp. So price reached support, triggers didn't break. That's a termination. Even with odds favorable momentum, if you took a trade into that area, that's an avoidable loss. Price reaches a divergence high, triggers remain below. Support, triggers remain above. Potential to break but doesn't. Resistance and a divergence high. Does everybody see that? Rule number 2, keeping you out of trouble, keeping you from avoidable losses. And then once the small and large got below 1-to-1s, 1-to-1s were broken. And guys, you'll notice those little tails, that was price retesting it as resistance. It's no longer support. And then when small and large got below support, there's the market retesting it as resistance. Weakness. There's your retracement. Didn't break. So rule number 2, guys, is designed on the large chart to show you precisely, and look at that, where the market may stop, where it could bounce, where it could become untradeable. And if you spend a little bit of time studying rule number 2, you'll discover that rule number 2 is the reason you have to sit on your hands most days. And that's large chart. Can you guys give me a Y if you're with me? Those are large chart terminations. That's the big slow chart. That's the large crowd reacting at areas. There's one termination condition on your small chart, and it's 3 divergences in the same price range. And 3 divergences in the same price range, it happens on small and large charts. It takes a while on a large chart, but on a small chart, you're going to see it quick. And this is your small chart showing you the change that you can't see on a large chart. It's giving you a little bit of a heads up. Even though these guys have momentum down, we're stealing their momentum. We're slowing this market down. That's what the divergences are telling you. So 3 divergences in the same price range, it may terminate the trend, guys. It could create an untradeable bounce. 3 divergences on a small chart is the only time I let a small chart talk me out of a high probability trend trade. 3 divergences on a large chart is a pretty good indication that they're done trying to go up. And sure enough, you can see what happened after that 3rd divergence. And I think there was another one somewhere. There it is again. 3 divergences. And that's where the reversal comes from. Talk about a strong indication. Connecting by browser, not the app, allowed the sound to come through. Awesome. Yeah, Jen hooked you up on that one. I love that. One of the things I really like about this room, guys, is it is a community, and you'll find that everybody's looking out for everybody here. It's pretty cool. So our large chart has done its job now. We have allowed the large chart to define the direction of the market, to let us know that we should be looking for trades up, and it's a long position that we're looking for. It has defined the momentum of the market through rule number 1. It has defined the areas, letting us know that we haven't reached Fibonacci resistance, that we're above the previous, and the path is clear. Does everybody see? This is what it's going to look like when it's time to find a trade, guys. Strong triggers, nothing in the way. Rule number 3 is all about precision. Rule number 3 says that you're going to use a limit order to buy or sell a pullback in an area inside of triggers. The limit order means that you're going to wait for the market to come to you. Buying or selling the pullback means that you're going to allow the small crowd to fight and push that market up or down against the trend. Areas, the same way they can create a bounce on the large chart that could stop a trend, we're going to rely on them on the small chart to create a bounce to go in the direction of the trend. And guys, the idea that they need to be inside of triggers is, in my opinion, the most important part of this lesson. Because large triggers, whether it's the small chart or the large chart, large triggers, these slow moving averages, are where price bars typically return. So you're going to use large triggers to define where the retracement, where that push from the small crowd is most likely to go. Somewhere from the top of the large triggers to the bottom of the large triggers. And this defines the most likely zone for the retracement. If you force those large triggers and those synthetic triggers, which are just the large triggers from the large chart, if you take them and they are overlapping one on top of each other, what you've done is you've recognized what we call favorable large triggers. So instead of having a large area where the market is most likely to retrace, you've created a very consolidated zone. And this is what's going to increase accuracy, and this is what's going to decrease risk. And when you put fibs, midbands, or yellow 1-to-1s inside of those favorable large triggers, you have the smallest little spot where the market is most likely to bounce and continue with the trend. And that's what we're going to do right now, is we're going to define an entry. And remember, large chart says up. Large chart has odds favorable momentum. Large chart has a clear path. It's time to go to the small chart. It's time to look for an entry. And when everything is up and strong on the large chart, everything's going to be up and strong on your small chart. And you have to avoid that temptation of just jumping in. When everything is going up, we're going to wait for the reversal bar, because this down bar, after all of those up bars, that signals the beginning of the fight. That's the beginning of the retracement. That's the small crowd getting to work. And we know that price tends to return to the large triggers, moving averages. So I have large triggers from the 5-1. They're smooth. I'm using these to say, wow, look at the momentum. And then I've got the large triggers from the 13-2. They have little steps on them. These are what we call the synthetic triggers. And all you have to do is draw a box mentally, or actually draw the box from the highest line of the triggers to the lowest line of the triggers. And what you've done is you've just defined where that retracement is most likely to go. Somewhere between here and here. And the tighter they are, the smaller this box becomes, the more accurate your entry becomes. But trigger lines aren't entries. Trigger lines don't create bounces. So once I understand where the market may return, I need an area, a fib, a midband, or a yellow 1-to-1. And I need it to be inside of triggers, all caps. And guys, this box, from the highest area inside of triggers to the lowest area inside of triggers, this shows me where the market is most likely to bounce in the direction of the trend from the large chart. This is identifying where that small crowd is most likely to fail. So we go from a pretty big retracement zone to a cute little bounce zone, and you guys are going to be able to study this, and with a little bit of practice and a little bit of trust, you're going to activate a limit order 2 ticks above that highest point of support inside of triggers. And now you've done all you can do. And we're going 2 ticks above because remember, your large chart is an absolute freight train of aggression to the north side with nothing in the way to create a bounce. We don't expect the small crowd to get a lot done. So we're going to try and catch them at the very top of the range, the top of the window. And if they make it, if they push down, if they get to your limit order, guys, you're in a long position. And you're not just in a long position hoping it goes up. You're not in a long position wondering if you did the right thing. You're in a long position with the advantage of a market where the odds are favorable for it to continue up because of the momentum, the strong triggers on the large chart. And you're in this position because there's absolutely nothing in the way on that large chart to create a bounce, no decision-making points. And you're in this position because you pinpointed with your rules precisely where that market was most likely to bounce in the direction of the trend through rule number 3. And guys, this is your high probability trend trade entry. This is the entry for a trade that has been proven, that will be proven by you to win more than it loses, to reduce risk, to increase profitability. And guys, once you identify momentum, it's an easy lesson. Learn how to identify termination conditions. Takes a little more time, but when you piece that with momentum, you'll be able to wait for the reversal bar on a small chart and know that it's not your entry. And you'll be able to define the retracement zones through the triggers and know that the triggers aren't your entry. And you'll be able to find the areas inside, all caps, inside of those trigger lines, and understand that somewhere in this window, the window of opportunity, is where the market is most likely to bounce. And guys, it takes a little time to develop that trust so that you can put that limit order 2 ticks above the highest point of support. And by defining where the market is most likely to continue, you understand that anything below the trigger lines, because the triggers define where the retracement's most likely to go, anything below the areas inside of triggers that should have created the bounce if this is going to be a winner, anything on the wrong side of the triggers, below those large triggers and along, this is where the market shouldn't go. And any line down here is not a part of your entry equation. Once you get below the large triggers, you don't know if the market's going to bounce and continue up. You don't know where it might happen or if it will at all. The advantage of rule number 3 is lost on the wrong side of the triggers. Someone asked me, Mark, what does all this volatility mean to Nexgen users? One of my favorite questions. What is all this volatility, all this up, down, indecision, fear, greed? What's it mean to us? Guys, it is 32 flavors of kick-ass. because volatile markets create the patterns. And as a futures trader, you can make just as much money short as you can long. It just depends on where the rules are met. So the reversal bar, when the rules are met on the large chart, is not your entry, but it starts the beginning of the pullback. You'll define where it's most likely to go through the trigger lines. It's not your entry when they hit the trigger lines. Triggers aren't bouncy. You're going to identify areas within the triggers, and you're going to say, this is where the trend is most likely to continue. And you'll develop the trust to activate a limit order 2 ticks below that lowest point of resistance. And you'll remind yourself that anything on the wrong side of the triggers is where your advantage is gone. Any line on the wrong side of the triggers is not a part of the entry equation. And your ability, and I think everybody should be able to do this in the first couple weeks with a little bit of focused study. Your ability to define where the market is most likely to continue has defined where the market should not go. If this is going to be part of that 70 to 80%, if the rules are met, guys, the market should not go 4 to 5 ticks beyond those triggers. That's going to be your initial stop placement. That's going to be where you say, damn it, my advantage is gone. They made it through everything that should have stopped them. I choose to no longer be in this trade. And any pattern that's proven to win 70 to 80% of the time is mathematically obligated to lose 20 to 30% of the time. And you'll recognize that getting that stop hit isn't a failure, but rather it's a cost of doing business, ladies and gentlemen. And small losses are a very normal part of a positive equity curve. So I encourage new users, scroll back historically, go back and look at the charts, identify momentum, identify path. And if you see that your rules are met, circle the tail, square the tail, and don't even worry about the small chart yet. Make sure that your large chart rules are met, that momentum and path is present, because that's your core. If you circle this tail or this wick, this tail is that pullback. And if that circle lines up with an area in the retracement zone, guess what? That's your pattern. That's what you're studying. That's what you're looking to repeat, because this is the pattern that typically wins 70 to 80% of the time. And you'll notice it didn't come from a strong top, but the pattern works. And you can go back on a large chart, and you can go back and you can say, a lot of termination conditions here. Here's one with the potential to break. And I circle that tail because the potential is there. And then I open my small chart. I'm not taking trades. I'm taking pictures at this point. And I go back to that spot. See if we can get there. Bum, bum, bum. And all I'm doing is I'm asking myself, did the market pull back to support inside of triggers? Well, it most certainly did. This may have been a loser, but you'll notice that the fib inside of the triggers created a bounce twice. Did overrun a little bit. This might have been one of those costs of doing business, and it was very much affected by these areas, because these areas are where decisions are made. These areas create those fights on the smaller, faster chart. If I back it up a little bit more, there's odds favorable momentum, and my large triggers are below the area, and sure enough, they pulled right back to resistance, right inside the triggers. And guys, this is a beautiful trade. This is the perfect look. This is what we're looking for every day. Can you guys give me a Y if you see it? The circle on the tail with momentum and path lines up with the pullback to resistance inside of favorable large triggers. Your job is to learn the large chart advantages. Dun, dun, dun. There's a circle from yesterday. Does it pull back to support inside of the retracement zone? Absolutely it does. And the market continues up with all that momentum. And it just keeps going on. And these patterns repeat themselves, whether it is a crude oil market or an S&P market or a gold market or a NASDAQ market. I mean, we did platinum yesterday. I think we pulled it up yesterday and looked at platinum, and it still worked. And I want you to see something. This is your large chart. That's a bar and a half. Does everybody see the fight on the small chart that's happening right at the key area on the large chart? This is why we insist on a clear path. Because who wants to get caught up in that nonsense, guys? So how do you get there? How do you get there the fastest? It's not taking trades, guys. It's not getting in and out of the market at every swing and turn. It's learning advantages. So chart reading 101, I'm going to give you this one. You can lose a lot in that nonsense. Amen, Jen. So your goal is to first be a chart reader, to look at your large chart and be able to identify momentum and path. And I promise you, Faya, Aflab, Bjoy, Aaron, guys, if you take pictures of strong triggers, 25 pictures of strong triggers, you're always going to know what strong triggers look like, and you'll be able to recognize it in a fraction of a second. And if you do the same with weak triggers, you know what it looks like when it's time to sit on your hands. And if you do it with a clear path and termination, taking pictures and then taking time on the picture to explain, this is why it's a strong trigger. This is what it means to me. What you do is you create this little neural path correlation. If I click on strong, what does it look like? Smalls above the large, space, colors match, rule 1 met, momentum, odds favorable momentum, look for rule 2. Could you guys imagine taking 25 pictures, writing that, and not understanding what it means to have momentum? And then there's weakness, and it's pretty clear. So go through that. More importantly, get them in the spreadsheet and take 2 to 3 minutes in the morning to reinforce those core advantages. As you go through this process, this one does 2 things for you. This is the high probability trend trade checklist. You'll use it first as you go take those pictures, because this shows you and defines exactly what it means to have a strong top or bottom. It's a no triggers through termination that reverses the market. And Max, this goes back, Mighty Max, check it out. First it's a termination. This didn't become a strong top until 10 bars later because of the distance from the triggers. First it's a termination, and now it's a strong bottom. It's not a rule for the high probability trend trade, but it definitely sets you up for the best of the best. You have to make sure that you have momentum, strong triggers, space between the two. And you can't confuse it with weakness, because when you have weakness, anything can happen. Commit to knowing the difference. When you look at your large chart and you're defining path, guys, I'll never tell you what's the right thing to have, but I'll tell you that if price reaches and the triggers don't break, you're more likely to lose than win. And if it's only potential, you got to get your management hat on. But if it's a clear path and you have momentum, look for an entry until that market reaches the next area, and then be willing to start over. Be willing to go back to termination condition to put that patience hat back on. You need to be able to define where the market is most likely to continue. You need to know where to put your limit order. You need to understand that anything on the wrong side of the triggers is not the best of the best. And guys, this high probability trend trade, here it is without the pictures. Nobody in the history of this high probability trend trade has been able to follow it truthfully and do worse than 70%. I've had engineers put it through the ringer. And I mean like 400 days of testing. And they ended up at like 82, 83%. Is this the only trade? It doesn't have to be. It could be. But guys, more than anything, you've got to build a plan, and your plan has to be proven, and it has to be testable, and that's the most important thing. How do I test this plan? I go back and circle those tails. I learn these looks. I prove that they win more than they lose. So this KISS plan gives you a plan until you can create your own. And I'm not saying that you need to create your own. You need to take ownership of this one and make it yours. But guys, this is a stepping stone. And it's designed to optimize your chances of success with the high probability trend trade as a new user. And then through simulation, through study, through class feedback, continuous practice, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. Everybody can't wait to find more trades, guys. Find the best trades first. There's two things that you have to know to sit down and trade, and you're not on simulator. So Bob B, this is very pertinent for you because you're talking about going live. Why will you enter a trade? Well, it should be because your rules are met, right? And the rules are a description of a pattern that has been proven to win more than it loses. And if you verify it, if you validate it, if you trust it, there's no reason to not consistently enter every time your rules are true. You won't know if you'll win or lose, but you'll know that if you keep doing the same thing, that repeatability creates a little bit of predictability. And when you know that it wins more than it loses, it helps remove emotion. And then second, you have to know why you'll exit your trade. Why would I get out of a trade? Well, your profit targets get hit. That's the best reason. Or your advantages go away. If I enter a trade, high probability trend trade, and the market goes 4 or 5 ticks beyond those triggers, my advantage is gone. I want to exit. If I'm in that trade and 3 divergences print, I want to exit. I've lost my advantage. Guys, trading with an edge is what this methodology, what this software affords you. Trading with a pattern that's been proven, guys, and committing to that pattern. So define entry. That's what we've just done. We have spent an hour setting you up to get into the market for the highest probability trend trade. Study it, learn it, know these rules, write them on your chart, police yourself. And then once you're in, you have to manage. And managing, I'll tell you right now, especially when you go live the first time, right, Bob? Management will make you pucker. All that bravado you had on simulator, holding through areas and fighting things, it all goes away. So the KISS plan, the management plan and the KISS plan, it's based on 2 contracts, plus 10. And this KISS plan is designed to do 2 things. The first thing is it's designed to show you where to put stops, guys, to trust those stops, to understand and to use the language where the market shouldn't go. It's also focused on getting you paid. One of the biggest challenges new users tend to have in their management plan is they hold too long. They take ridiculous amounts of drawdown that would never make sense in a live market with real money. So this KISS plan is designed to get you paid, to become comfortable getting paid, to accept that the whole goal of trading is to get paid. And you'll change it, you'll see things, you'll learn, you'll get to read your indicators, you'll develop your own management plan, but until you do, allowing your management to be every bit as mechanical as your entry, guys, it helps remove emotions. So I've written the most pragmatic, emotionless, if-then trading management plan I could ever come up with for you guys. And it is dependent 100% on your ability to enter the market where the market is most likely to continue. So if entry is 2 ticks below resistance inside of triggers, there's your high probability trend trade entry, then the initial stop is 4 to 5 ticks beyond the triggers. And this is where the market shouldn't go. And guys, you're going to know your risk before you ever enter the market. So Faya and Aflab and Aaron, if I get in at 71.34, 2 ticks below that resistance, my stop has to go 4 to 5 ticks beyond the triggers. If I'm not comfortable with $150 per contract, I probably don't trust my plan. But more importantly, if I try to shortcut it and put a stop right here at 42, well, I'll give up $70. I'm still in the retracement zone. And if I try to put it below resistance inside of triggers, Murphy's Law says that they're going to tap my stop and they're going to drop like a ton of bricks and do everything the indicator said they were most likely to do. So accept your risk, guys. Risk is a part of trading. You've got to put yourself in the kill zone to be successful in battle. That's a Sun Tzu concept, Art of War. Your targets in the KISS plan are predefined. $100 and $200. That's for crude oil. That's for the S&P, those markets that flow really well. And if they don't hit your stop, if you're not stopped out of that trade, then a reversal bar printed. And when if a reversal bar prints in the direction of your trade, you're going to redefine where the market should not go. Because this reversal bar is confirming that the market's going down from the area where it was most likely to go down from. It is confirming that it's going down with the momentum, that it's going down with the clear path. This confirmation bar is going to allow you to redefine, to move your stop, to put it 2 ticks above that reversal bar. And it doesn't guarantee a win, but what it guarantees is a tiny little loss in the event that something doesn't work out. So you go from $150 worth of risk to $30 per risk. Your targets are still at 100 and 200, and guys, you're back in sitting on your hands doing nothing, letting the market do what the market does. If they don't stop you out, then they're going to your first target. And guys, this is confetti poppers and champagne. Because if price reaches your first target, one contract is automatically removed, and those funds go into your account. Guys, you're successful, and successful breeds confidence. You're a winner. And now with one contract remaining, you're going to go to break even. So you have zero risk. Profits have been taken. Life is good. Palms aren't sweaty. And guys, that second contract is purpose-built to teach you trusting the idea that with odds favorable, momentum, and a clear path, that market is more likely to go to the next key area than it is to arbitrarily reverse in the middle of nowhere. And if they don't come up and get you break even and go to your second target at only $200 away from your great entry, that's a $300 trade, guys. And that's a $300 trade that is 3 to 4 minutes of your life. That's not your trading day. That is a moment. That is a flash. That's 180 seconds. And if that's the best you do every day, it's a $75,000 a year, 252 trading days. Doesn't include commissions, I know. Add $100 to it, you're in 6 figures. And here's the great thing, guys, is the goal isn't to make all the money every trade. The goal is to be consistent, to make profits daily, to be able to recognize a pattern, to feel good about the advantage, to take the trade, to take maybe 5, 6, 7 trades in a day, knowing that you're going to lose 2 or 3 of them, and coming out $400 to $500 in the good every day as you learn to be consistent, following that KISS plan. And then there's great options like mirroring accounts. There's a gentleman in this room, his daily goal is $1,500 a day, which is $300,000, give or take, a year. But he mirrors that $1,500 on 10 different accounts, which means every day he makes $1,000, he's actually made $10,000. And if all he did was make $100, he's still making $1,000. So learn how to recognize the best of best. Learn how to get in. My promise to you guys was that I would give you everything that you need to be successful with the software by the time we were done with this little bit here. So I'm going to recap, and I'm going to drop in the room the everything you need zip file. We learned the rules for when it's okay to trade. We discussed each rule individually, how to identify it, what it means to you, how to study it. You were given a place to study it via the spreadsheet to be able to commit it to memory. You guys have the ability to get feedback on everything. You know how to annotate the charts. You can place them in the room. Everything you see, everything you do is a private session with me. And my promise to you is that I will give you every ounce of my ability to read these indicators, to praise what you've done well. And if we need to find some solutions to do it better, we'll do it together and put you on the right path. You're being given a trading plan, a plan that defines precise entries, that teaches you how to manage, that opens the door for you to go find more on your own when you become a chart reader. And that trading plan isn't just the high probability trend trade. It takes you to that 50-50 trade, to that medium probability trade. But until you learn the lessons from the first trade, the second trade is going to be more difficult because you have to be able to recognize a strong top. You can't hesitate on the look of momentum. You need to know how to identify divergence, and it has a completely different management plan. So every time you add a trade to your plan, guys, you add entry rules and you add management rules. And the more you add in the beginning, the more difficult it is to be consistent. You have the ability to study the looks, to study the basic rules looks, to go back and see the client looks, to commit the entries to memory. You have a place to build your plan as you grow outside, as you create pictures that show those high probability trend trades from your study, and you have a place to track your progress, guys. You have everything that you need to be successful with the software, except for one thing. You don't have the experience to make it easy. You don't have the seat time, the time on the pond, as Pete would say. So you have to go through this process and you have to learn these concepts, guys. And once you do, it's absolutely amazing what can be done with the software. It's absolutely amazing the things that you'll see. Nexgen's been around for 30 years. My Ninja Trader crashed. We have been around for 30 years, and for 30 years we've been teaching people to read indicators and to put you in a position to make your own good decisions. And the people that work the hardest, the people that take the most pictures, the people that take advantage of the spreadsheet, and most importantly, the people that take advantage of the feedback in the classroom, these are the people that find success the fastest. So what we're going to do for the next 2 hours is we're going to look at your charts. So you guys are going to tell me what you see, always. Here's my momentum, here's my path, here's my entry, here's my exit. Did I read it correctly? Was there a way to have less risk? Could I have held for bigger profits? And guys, every trade is a private session. But as we go into the second hour, I'm going to remind you, and this is the big reminder for everybody, the key to everything is having a foundation. Understanding the basics, and then each day or week compounding a little bit. The idea of, I love it, it's a Japanese philosophy, it's a business philosophy, Kaizen, meaning that it's incremental progress, that every day you're like 1% better instead of trying to find the finish line before you ever start the race. So for you new users, I blanket with very conservative rules, recognizing advantages, and I give you a solid plan that optimizes the chances of success as you learn to read your indicators. So for all new users, terminations are bad, and no momentum is bad, and areas beyond large triggers are bad, guys. And it's these blanket rules that increase the likelihood of success. And success is what creates the confidence and opens doors for more. And these things aren't always bad. And you may find a way to work around them. But until you have the seat time, the experience to know when to use exceptions, it's just safer to embrace the blanket rules. And just like anything, the more time you spend with it, the more you'll see. And this opens the door for you. So as we go into the second hours and you see people doing trades that don't fit this high probability trend trade rule, and you see people taking trades in determination conditions, and you see people entering not in favorable large triggers, guys, realize that if you're brand new with me, you're learning the process that yields results. Did anybody watch the RBC over the weekend? Any golfers in here? Did you see the Titleist commercial with Justin Thomas, or maybe it was Jordan Spieth? And he kept referencing the process, going through the process, doing the process, not worrying about the score, but focusing on the process that produces the score. Guys, trading is very, very similar. It was Spieth. Trading is very similar. Nobody gets birdies on the golf course because they want to shoot low. It's the process, it's the swing. So learn the process and the results tend to follow. This is where the KISS plan comes in. If you keep it that basic, if you follow simple rules, if you're okay not looking for all the trades, but rather the best trades, you can find an extraordinary level of success. I've had men and women fund in those prop firms in their first 30 days with Nexgen using that KISS plan, embracing the KISS plan. And I've been watching it for years, guys, but the further new users deviate from the simple, the longer they tend to take to recognize patterns and to find consistency. So question everything. I can't stress this enough. If you have a question in your head, let it fall through your fingers on the keyboard. Get it into this room. Give me the opportunity to answer it. I want you to learn. And then here's the most important part. And I say this for my wife. This is her phrase. Give yourself a little grace, guys. You're brand new. It's okay to be brand new. You are a freshman in college. You know that you're going to be a brilliant architect one day, but I can't let you build a bridge yet because you'll kill somebody. Think of it that way. This is a career. This is a business. This is a job. You're learning how to do the job well. So I'm going to take about 5 minutes, and I'm going to go stretch my legs, and I'll leave you guys with crude oil that had odds favorable momentum and the potential to break. and it pulled right back to support right inside of that retracement zone. That sounds familiar, right? Should we play broken record here? Um, and when I come back, we're going to start clicking on charts, guys. So go stretch your legs. I'll be back in 5. All right, you rock stars. So just for you guys that are still kind of new, whoops, I have to scroll up all the way through here to get to the pictures. Um, so I scroll up and then I scroll down to have the conversations, and then I scroll up and I scroll down. Guys, if I ever miss a picture, just tell me. Just go, hey, Mark, you missed me at 9:45. Don't say, hey, Mark, you missed 6 of my pictures. Uh, because usually I can't find them all. Yesterday I did. Joel, fortunately, yours were grouped together. But give me a timestamp and it helps me a lot. All right, so we're going to go through. Wayne, are you with us yet? He's still doing yoga. So we're going to start with Pete. And it's always the Pete show. I love it. One of the reasons Pete is such an outstanding trader is that Pete takes the time to post in the room. If Pete has a thought process, if he's working on something, Pete's not afraid, even though he has more experience than most people in the room, to come in, to drop something in, to get a little feedback, to make sure that he didn't miss something. And Pete also has a trading plan. He knows his rules. So let's go through and see what Pete did. Woke up to this nice 50-50. And of course, Pete's not a 50-50 at all. And one of the things you guys are going to recognize, and Pete's got thick skin, he knows, is this isn't a 50-50. This is directly into resistance. It's directly into a divergence high, and absolutely none of the trigger lines have broken. Newer users, FIA, AFLAB, can you see how the momentum is great, but the path is not clear? This is an important lesson, not because Pete shouldn't have taken this trade, but because Pete understands what he's up against. He knows that it's not a clear path, and because it's not a clear path, Pete can say, I'm not going to hope and wish and want, I'm going to manage a little more assertively. So Pete gauges, I have no divergence on my small chart. I have strong triggers on my small chart, and I can enter on the way up. Because I know of the troubles, I'm going to force it to head in the direction of my trade. And guys, look where Pete gets paid. A couple ticks below the things that could stop the market, that could create the problems. Pete, you are a trading into terminations guy. You always have been. But notice that Pete trades from the area where the market is most likely to bounce. And he's out at the area that is most likely to stop and create an untradeable bounce. And guys, I'm not saying trade into termination conditions, because more often than not, you're going to lose. But understanding what you're up against creates an opportunity for you to manage assertively, to get to less risk, to take quicker profits. And Pete, that's great execution on that one. And then it does break. And then it becomes that 50-50 look. Then it becomes that smalls through, large below, smashing with odds favorable momentum. And Pete says, I feel really good about exiting where the market could have bounced. But when it broke and it didn't bounce and all that momentum said we're likely to go up, Pete took a momentum style trade based on momentum on 2 charts. And FIA and AFLAB and Aaron and you guys that are new in here, I want you to see this. With all of this momentum and not trading into something, and look at the odds favorable momentum on the small chart. Pete says with this much momentum on both charts, it's going to be difficult to stop this market. So he just jumps in, jumps the fudge in, if you will. And he takes quick profits because momentum is fleeting. And then once he gets this divergence, he exits. He says, all right, divergence is a loss of momentum, and momentum is why I took the trade. What a great reason to exit. Great job, Pete. And then he has weakness on the large chart. Rule number 1 not met. And no areas inside of favorable large triggers. Rule number 3 not met. And let me show you what Pete did here, and it's brilliant, and you're going to love this. If you're a new user and you wonder why I talk about advantages so much. So Pete looks at his charts, and he says, I don't have momentum. There's no separation between the small and large. And I don't have an entry area. I don't have an area inside of triggers. And what you'll do when you start talking about these advantages is you'll say, why on earth would I hope the market goes up or down with 66.6% of my advantages gone? Does that make sense, everybody? Your ability to speak in terms of advantages, your ability to say, I don't have strong triggers. I don't have an area inside of favorable large triggers. Does it make sense, Lonnie? If it takes momentum and a path and an entry area to create that best of the best trade, Lonnie, are you with me on that? That's the recipe for a trade. So, Lonnie, if you forfeit momentum, is it the same great trade? No. 33% of your advantages are now gone. And then, Lonnie, if you still look at your charts and you say, but I don't have an entry area either, that's another 33% gone. Lonnie, are you willing to jump in to risk your money on nothing more than a clear path? It's your ability to recognize the advantages that gets you in the position to say, I just don't think I want to risk it. I don't want to take that trade. Too much is going wrong with it. I choose to not enter the market. And guys, by not taking this trade, this is a very avoidable loss. If you take the trade in hope, even though there's not momentum, even though there's not an entry area, you're more likely to lose than win. So Pete, this is great. It's not a confirmation bar if the rules aren't met. And that's one of the greatest lessons you can get. This is just a reversal bar. It's not a confirmation bar. You're missing too many things to feel like it's confirming a trade. Great picture. Weak top, smalls below the large, large above. Pete says, I'm going to see if I can capitalize with that momentum one more time. I'm going to let it get below the fib, and with the potential to break, I'm going to see if I can make a little money. Quick profits because of momentum, and then out with a loss of momentum. Nice execution again. Not a high probability trend trade. And here is where the challenges started a little bit. So mid-band holds, all the triggers above, smalls are railing up, large are rolling, and Pete tried to go short. Pete said, I've got odds favorable momentum against me. I'm not, oh, you're testing a stop on sim. Okay. I'm going to do the chart read. Pete, let me read what you wrote. So I built a custom trailing stop. I'm testing it out. The first trade, it stopped me out at break even. Second trade stopped me out with 6-tick gain. My normal exit would have been 2 ticks above the fib, so I gave up 4 ticks. Still tweaking it. It's pretty cool, though. Makes a cash register sound every time price moves 2 ticks in your favor. I like it. But guys, let's look at what Pete did. Small setup, large setup, large setup, small setup, and Pete tried to go short. And Pete had his head in the game, and fortunately he got out break even. But guys, that's fighting everything. That's fighting the direction. That's fighting the momentum. That's fighting everything. And Pete tried it, and it didn't work. And then from the termination, the large triggers roll, the small triggers roll, and Pete has momentum on the small chart and gives himself a fighting chance to get back to the fib. From the termination, small triggers roll, and the small chart is showing change. 1, 2, 3 divergences. Pete says, we're probably going to go retest. And I like this one, Pete. That's good usage of the indicators. First one's fighting everything. No momentum, no clear path. Pete jumps in anyway. All right, new users. And Pete, every trigger above support. Small triggers above the large triggers, not even momentum down. Letting the small chart talk you into a trade that you shouldn't be into. Looking at the small chart and saying, oh my gosh, I have an area inside of favorable large triggers, and forgetting to let the large chart lead the way. Guys, this is the recipe for financial suicide. I know, Pete, but I have to turn it into a lesson. You don't need feedback on it, so I have to turn this into a lesson for the class. Guys, when you take ridiculous no rules met trades, you're training yourself that it's okay to take it. You're teaching yourself that you're going to get lucky every now and then, and your brain's going to chase that money. So this is, Pete knows he shouldn't do it, and it's okay to not even post these. Because you don't need the feedback on this one, Pete. You know you shouldn't take this trade. You know it's more likely to lose. And all this does is every now and then, you're going to trade directly into a termination condition and get away with it. And what you're doing, guys, is you're creating these short-term victories that typically result in long-term failure. So I'm not playing trade police, but if you're not willing to trade it on your live account, your best option is to not trade it at all, to not get lucky, to not get that dopamine kick, to not convince your brain that it's okay to do it, because your brain doesn't know the difference between sim and live. And short-term victories typically result in long-term failures. That is the cliche phrase for when you break your rules. Great stuff, Pete. All right, let's see. Bob, be the man. And Bob, you're live now, right? So why he took this trade? Strong top. Price reached resistance. All the triggers remained below, and it reversed the market. Absolutely. And then Bob had odds favorable momentum. Smalls below the large, larger wide. And he had a clear path. Divergence quit printing. He takes a pullback directly to resistance inside of favorable large triggers. He knows where his stop belongs. And he gets paid. And then he gets paid. So there's one trade, and then everything says down. The triggers are strong, the path is clear, and Bob takes another entry and gets paid twice. And then the rules are met again, and Bob takes the third trend trade and gets paid all the way down to the fib. And Bob, is this day one live money, real money, going after it? Because we're about to have, not yet. Come on, Bob. Why would this not be live? I thought you were live. This is your plan. This is everything. This is 100% rules-based. And guys, the reason we talk about a trading plan, the reason we talk about having a solid, written, repeatable plan is because you do the same thing. Bob, this is gorgeous. Don't give this up when it's real. This is the plan that works. You've proven that it works. Great job. Odds favorable, 50-50, potential to break with all that momentum, no divergence, strong triggers, perfect entry, and getting paid. Everything's perfect. Everything's perfect. And Bob, can we talk about this? We're calling this a weak bottom, right? Sometimes they overrun. These are areas. Sometimes they overrun. Your small chart gave beautiful confirmation that that was probably a little overrun by printing 3 divergences in the same price range. I would go ahead and be comfortable treating it like a strong bottom. Does that make sense, Bob, and everyone in the room? Ideally, for the brand new user, absolutely no triggers get through. But these are areas. Sometimes they overrun. The small chart creates confirmation of the overrun. And Bob, beautiful large chart. Look, perfect entry. $500. Was that your first live trade ever? Congratulations. You followed your plan. Outstanding, man. Nicely done. Welcome to the live market. I got no worries with you. All right, let's see. Bob B, good morning, triple exclamation point. Weak bottom. Strong triggers. Pull back. So why you took this trade on Sim? Let's talk about it. Broke all the rules. Broke your rules, right, Bob? Your rules are the Trina, I'll answer that in a second. Broke your rules. Your rules, that the ones that got you to the live market, right? But it worked. So now, Bob, you're in this, oh my gosh, I'll take trades that don't fit my plan because they win, right? But do they? But let's talk about this one because this is great. Bad top, right? Mid-band typically holds from a bad top, creates a bounce, and you don't just arbitrarily jump in. You know to not take the short. And then when everything rolls and heads up, all this is a beautiful clear path with really strong small, with the larges rolling, with one area right at the large triggers to create a bounce. This is a continuation style trade. It's not a trend trade or anything like that, but your execution is beautiful, Bob. From the bad top, it has the potential to run back up, and you waited for everything to agree. And when everything agrees on a chart, dude, it's hard to not do well. Nicely done. I like the trade. And then Trina, so 3 divergences doesn't create a strong bottom. So we're going next level, right? The rule is no triggers through termination that reverses the market. But Trina, they're areas, right? And the small triggers get a couple ticks through. 3 divergences, I can say, all right, that may have been overrun. That might have been a little bit of overrun. There was so much momentum on the large chart, it's hard to hit the brakes. They barely eke through, and 3 divergences lets me know that some pretty big decisions were being made here. So while technically it's not a strong top or a strong bottom, I've got a little bit to make me feel better about taking the 50-50. Does that make sense? Awesome. Good question. Thank you for that. I love the questions, guys. Questions are what make this room the best. Questions are what make this education process so solid. All right, let me get to the next one. Sound effects make everything better. So Miss Adriana, and this goes back to, we talked about this when we're talking about the whys, right? Why on the large chart? What about this chart made you willing to risk your money here? And this is one of the things that I think it's important to ask yourself. She said she had a clear path. So the large chart is in this strong trending market. Everything is screaming up. Her range chart has odds favorable momentum. Her small chart has momentum. And what Adriana took here is a little snapback right to the fib. And what she's saying is that with all this just strong trending up, and we're almost through the area, and we got above the area that could have been problematic and pulled back to it, Adriana takes a gorgeous entry, a gorgeous momentum-based entry, and she rides it up. And then when 3 divergences print, Adriana says, whoa, that could stop the party. Let me take an exit because my advantages are gone. Adriana, I was trying to use this as an example for why we annotate. To make it repeatable. I know you're watching the video. I love it. I think it's great usage of a strong trending market. It's a momentum style trade based on what the large chart's telling you. I just want to make sure you know why so that you can repeat it, because this is gorgeous and you did it really well. Whoops, and we answered the albino fib, or we decided that we didn't have the answer. All right, Miss Cindy, let's see what's going on. Joel, what came from a bad top? Oh, are we talking about Bob's? Sorry, that's one of the challenges with the scroll. Because it came from the bad top, that potential for it to continue up is in play. Perfect. And rather than just jumping in, letting the triggers get in the direction, because you know that's what that creates a little more success. Good lesson there. All right. Strong triggers, clear path, and pull back to the area inside of triggers. Miss Cindy, will you tell your husband that he's missing fibs on his large chart that are present on the small chart? And these fibs sure would have helped him a lot. Guys, so your large chart, the way it's set up, I'm going to show you this real quick. Cindy, are you in here? Because I'd love for you to relay this to him. So the large chart is set up, guys, to have Fibonacci areas from 3 different time frames. So your large chart fibs will extend all the way to the right, and these are native. So these would be your 13.2. And then the skinny little fibs that stop printing, that don't extend all the way to the right, those are from your smaller time frame. And then the fatter fibs that don't go all the way to the price line, those are from an even higher time frame. So what you're looking at every time you look at your large chart, guys, you should have Fibonacci areas from 3 different levels. And this is one of the reasons that there's so much accuracy using the large chart to define termination conditions. Because I want you to see, here it was the 21 fib that stopped the market cold. Down here, it was the 5-1 that didn't break. And then right here, it's the 13.2 that's creating problems. And here it's the 13.2 that stopped it. So each of these time frames is really important to have on your large chart. So if you come in, to your large chart and you're missing some information, and let me show you how this works. Large chart, small chart. This fib should have been right about there. So, Cindy, I hope you're listening, and I want everybody to listen to this. If I had all of my fibs on this chart the way I was supposed to, and it may mean that you need to clean out, get with Jason, rebuild a workspace, suddenly this is a 50-50 trade. And not only is it a 50-50 trade, Miss Cindy, it's a 50-50 trade with multiple divergences, letting me know that I'm losing momentum, and it takes momentum to break areas. And suddenly this isn't such a good trade. It's a medium probability trade with a lot of problems. And I hope that made sense. And I'm not sure if you're still in here. But guys, if you don't have all 3 time frames worth of fibs, you're doing yourself a disservice. Odds favorable, clear path. And we are pulling back to an area inside of triggers. After 3 divergences and another divergence prints, and there's that fib update again. So once again, it's a 50-50 on the large chart losing momentum, and you can see the struggle in the fight here, and a nice job capturing a little bit. So the 3 different fibs, they're from 3 time frames. Let me give you the picture, Lonnie. And the reason I say this isn't because one's more important than the other. There's small chart, large chart, and then an even higher time frame. And Lonnie, they're put on your large chart because this is how you're going to get the highest level of accuracy. And they're put on the large chart because they can all stop the market. Again, 5-1 fib stopped it. 13.2 fib stopped it. 21 fib stopped it. They're all equally important. We use the large chart to define termination conditions, Lonnie, because I want you to see something. And I took this picture. Let me find it real quick. Maybe. There we go. Right here. Because your large chart is a bigger, slower moving chart, if the moving average, if the small triggers from the large chart smash through that area, it's going to look like this. And you're like, yes, the potential is there. On your small chart, it might look just like a termination condition. And this fib is that fib. But see how here you see that potential to break, but here it looks like a death sentence? So having those three different fibs on there, it really pays dividends. It really helps with the accuracy. And more than anything, it keeps you out of a lot of trouble. Because if it's not actually a clear path, Cindy's husband's chart said, man, just don't even worry about those divergences. Enjoy that momentum. Enjoy that path. But the reality is there were some problems going on, some things that may have needed just a little bit of management. Does that make sense, Lonnie? And Cindy, I'm not sure if you're even still in here. So I hope if you watch the video that makes sense. You guys want your synthetics. You want your synthetics on the large chart. They create a huge advantage. John Novak's gone through 30 years of study to give you guys the absolute best of the best. Three divergences in the same price range. Great recognition on that one. If it can stop a trend on the small chart, it can certainly stop one on the large chart. 50-50. Odds favorable momentum, potential to break. Pulls right back to the area. But because of all the risk, maybe she waits for confirmation. And then just quick exit. That one was break even. I'm not sure why. And then that one was 2 ticks. 1 tick. So break even, 1 tick, and then you finally let one go for a few. Had divergence here on your other computer. It didn't show up, so you drew it in. Okay. So Jen, I have to ask. Why bother taking the trade if you're going to exit 2 contracts at a tick each, or 1 at break even, in at 10, out at 10, in at 10, out at 9, and then finally you let the last one run for 7 ticks. But what are you practicing? Jumping out fearfully? Is that the lesson? And forgive me if I sound like I'm beating the hell out of you. Why are you practicing 4 lots? Because this isn't practice anything. This is you saying, oh shit, I have a 4 lot. Let me get the hell out so I don't lose money. Is that right? Forgive my language, guys. Sorry, apparently I'm wound up today. So what good is it doing you, Jen? Does that make sense? Why not just hold the 2 lot? You would have made more money. If you're too fearful to be on 4, get so comfortable on 2 that you can't wait to go to 3. And then get so comfortable on 3 that you can't wait to go to 4. It's the same trade, right? But Jen, there's no trading plan in the world that says take your entry and get the hell out, break even instantly. All that did was cost you 2 contracts worth of commissions. So this one for a tick, you haven't made anything. You might as well just trade a 1 lot and hold it for 7 ticks. You would make more money. So Lonnie, when you look at your small chart, if you see a fib that runs all the way over 63.26, you should see it over here, 63.26. That's the easiest way to do it. Look at your small chart and make sure the fibs from the small chart show up on the large chart. Make sure you have these fat ones in there. And if they're not there, then you need to go through. And the easiest thing to do is to right click and make sure that your tick replay is in place. Because watch what happens when I take the tick replay off. The only fib that I have is the one native to the chart. And then once I put the tick replay back on, my synthetic time frames come into play. That's the easiest way to do it. And of course, if you're fearful about it, just get with Jason. But that's what I look for, is I'll squish it, and I should have fibs that stop, and I should have fibs that go. And if I don't have both, I'm missing synthetics. Sorry, Miss Jen, I didn't mean to put one on the chin there, but gotta practice like you want to play, guys. And fear is a horrible thing to practice. All right, Miss Adriana, you did have a weak top, but look at all that momentum. And then when you reach the mid-band, I love everything about your trade. Perfect pullback, right to the areas, right in the retracement zone. Beautiful stop placement. And then when you get to the mid-band, you put mid-band holds. And Adriana, did you notice that the large triggers are a full bar away when you hit the mid-band? And ladies and gentlemen, when we talk about the mid-band and whether or not it gets to be a termination condition, the large chart mid-band is always a termination condition if the large triggers are a full bar away. Because we all remember that price returns to large triggers, and when they're a full bar away, anything that's been hit is definitely a termination. So beautiful job trading to it. And then you could have even just taken profits, or you let one have the opportunity to run. Nothing wrong with that. Really great trade, Adriana. Using momentum and the potential to break, and then identifying that you hit trouble. What's going on, Wayne? Good to see you. Nicely done, Miss Adriana. I know you're just catching this on video, so high five. And then Pete, 3 divergences, say no more long. Not weak triggers. This is strong triggers. This is odds favorable momentum. Once it breaks below, Pete jumps in. And 4 ticks stop out. That's pretty close. You didn't really give it a chance to do anything. And then it turns into the trend trade. You get in with confirmation. And there you go. You ride that one down. And the value of a trailing stop is if it breaks trouble, which it initially did, you run with it, but it protects your profits if it reverses at trouble. And Pete, I don't disagree with your idea. With the idea, but you're not letting it run. Guys, if your stop is closer than 1 bar's worth of information, you're not doing anything to let it run. You might as well just exit at the bottom of the bar and take a re-entry. They all have 28 days, Joel. Every one of them does. Brum-bum. I know that one. Right on. That's super, super tight. I can see it on a reversal bar, but what happens if it goes 1 tick above that 1-to-1, and then the 1-to-1 just creates the beautiful momentum trade? Super, super tight. I like the idea. It's fun to play with those. I've built one too, Pete, and I'm trying to find the perfect recipe. And I haven't found it yet. Not yet. But I will, dagnabbit. Because I'm stubborn. And I love patterns. All right, Bob B. the man. 3 divergences on the large chart. Guys, it makes me so happy that everybody is recognizing that everybody's recognizing the 3 divergences. So, Bob, now we have to ask, isn't 3 divergences a termination condition? None of the triggers got above those 3 divergences. It reversed the market. Couldn't we call that a strong top? That's a weird look, but I think it qualifies on the rules. And then you get odds favorable momentum. And you say this one with the losses of momentum is too risky. But once it gets below and things start to clear, you take it perfect. And you know that one-to-ones, I understand the one-to-one exit because it could create a bounce. Nice job. Great trade. And be careful with trailing stops. I like a trailing stop. I really do. There's a difference between a trailing stop and an oh shit, I hope it doesn't come back and take any of my money. And if your trailing stop is so tight that it doesn't give any room to wiggle, it's easier to just exit. Like I have a trailing stop on my NASDAQ trades, and it's a $200 trailing stop, Bob. I'm willing to give up $200 for the sake of a runner if the path is clear. It's not at $20, to hell with it. I don't know. I can't write your management plan for you. Does 10 ticks make sense? How big is a 5-1 bar? Okay, I like that. So you're saying, so large short had momentum, large short had a clear path, large short had room to the target. You would be 10 ticks behind this at where, like 11? Just trailing it? That makes sense on this one. As a $100 trailing, it's essentially the same thing as, yeah, that makes sense. It gives it room to breathe. Nicely done, Bob. Great first day for you. Great first day for you. All right, Lonnie said, did this trade on the ES. All right, let's see. Weak bottom, that's okay. Odds favorable, clear path. Trying to do the confirmation interest was slow to react. That happens. But with odds favorable and a clear path, it still goes right to the target. Nicely done, Lonnie. It's hard to time it. And you never got to your area. And that's kind of what threw this one off a little bit, is you never got to your area inside of triggers. So what you did is you kind of just jumped in on the move, but you took it right to where the market was likely to go. Nicely done. With momentum and path, you'll find a way. And you did a nice job of it. Let's see. Ron says, check it out, guys. There's this thing. If you have momentum and room to your target, and your small chart has momentum and room to a target, why not take a trade? Why not capitalize on momentum? And that's a 4 lot, right? So what is that? 115 per on a 4 lot? 460 in a couple seconds based on momentum and path. Nicely done. Use guys, tearing it up. All right, Miss Trina. I love it when you guys give me multiples. 1, 2, 3, 4. 1, 2, 3, 4. Let's see what Miss Trina's up to today. Strong bottom, no triggers through. And Trina, I gotta tell you, the way you annotate, it is 79 with sun, beach calling. Oh man, have a blast. I think I'm gonna go swing clubs today. It's gonna be like 90 and sunny. Perfect. Trina, your annotations are so good. They're so clear, concise. Anybody in this room could look at your chart and know exactly why you did what you did. Strong bottom, no triggers through, odds favorable, triggers wide, 50-50, potential to break, divergence printed after you entered. So let's talk about this one. And you got stopped out. But where did you get stopped out, Trina? You got stopped out at an area of support inside of triggers, didn't you? You got stopped out at an entry. So I'm going to give you something to think about. And your rule says, if I'm correct, your rule says, hold on, if divergence prints, no trade. That's the KISS plan. Is that what you're trading? All right. So I'm going to give you a little tip. Divergence is not true until halfway through the second down bar. So what that means, if my rules say no divergence, I can't enter before I know whether or not it's true. And you'll see the potential because of the flashing negative number. And this is one of those things, Trina, where I like it. You're looking at it, it makes sense, but you didn't give your rules the time they needed to be true. And it still went down and it stayed in the zone and it bounced off of here. But because you got in up here at 48.75, why do you have 7 ticks of risk? Why isn't your stop where the market shouldn't go? Was it a conscious decision? Was it an accident? Because just because you're not cool with the risk doesn't mean that where the market shouldn't go changes. And I'm not saying that's what happened. Okay, so you use the reversal bar. That's fair. That's fair. Could you have re-entered with confirmation? That's one of the things too, is guys, just because a trade fails and you take that little hickey, it doesn't mean that it's not still a trade if your rules are still met. So I think that something to think about on that one is if your rules say divergence can't be true, then sometimes you just have to pump the brakes and wait to see whether or not it happens. Great job on that one though. It all makes sense. Odds favorable, clear path. Fear of missing out just jumped in. So you got in at 76-ish and you got out at 79. So you made what? About 50 bucks a contract? You made 100 bucks there, Trina? So the only thing you had going for you was momentum, right? Momentum and path. Is there anything wrong with making a quick 100 bucks? And then what happens here? It can't be a trend trade because there's no areas inside the triggers. I love this. I like everything about it. Quick profits. Not giving it up. You know all it is momentum. Nicely done. All right. There's that little quick hit. And then odds favorable. Weak top, 50-50, no divergence, lots of risk, should have waited for the bar in the direction of the trade. Entry at the area, perfect. There's nothing wrong with it. There is a lot of risk. You could have taken the confirmation bar for sure to reduce it, but it's a great trade. And you know what's cool too though, is you're already below the 1-to-1s here. And the 1-to-1s are creating a little bit of a backstop as well at 71.50. So that's the area that you're anticipating breaking, which means that's the area you're anticipating everything going down. I think it's nice. And then out at trouble. Great trade. I love that you know where the risk goes. And you know how to mitigate it. And there we go. No momentum. No areas inside of triggers. No momentum on either chart. So you're working with just a clear path. Right, Trina? Just hoping that it goes up. You knew you were going to get it? Yeah. I'm so mean. I mean, I love that you didn't lose money. But yeah, this is the one where it's okay to write a little note on it. This probably isn't my path to success. If you're going to take a momentum trade, guys, you might as well have momentum on both charts. It definitely helps. Is this tradable? So, Lonnie, what a great segue. Is this momentum? Small's inside of large? This is for everybody in the room, guys. No. So it can't be a momentum trade, can it? Is it? Everything's trade. You can get into the market no matter what. I have a clear path. I don't have momentum. Well, Lonnie, can you have chocolate ice cream without chocolate? Can you have a ham sandwich without ham? No. So how could you have a momentum trade without momentum? It's right there in the name. It's like going, hey, I'm going to have a steak sandwich, and then asking, well, is it vegan? Well, of course not. It's steak. It can't be. So when you're thinking about momentum, Lonnie, let it be momentum. Let it be separation. And then Ron does it. Let me show you what Ron did on his to give you a visual. Where did his go? There it is. Do you see the momentum on the large chart? Odds favorable momentum, 100%, right? Look at the small chart. Odds favorable momentum, 100%. So Lonnie, with this level of momentum and nothing creating bounces, that's that momentum trade. That's that taking advantage of a really strongly pushing market. But you've got to be able to say to yourself, I have to have momentum to take a momentum trade. And if the momentum isn't present, I'm probably better off sitting on my hands. Does that make sense? That's a great question. I don't see any rules met there. That's an awesome question. And one of the most common questions that, well, no, your large chart said no momentum, Lonnie. Large chart leads the way. Watch this. What rules are met for any trade that I've ever talked about in the room here? I don't have momentum. Do you see it? Not until all the way out here. But in the circle, I don't have momentum. I have a clear path. But if my first rule isn't met, why am I worried about it? Why? Who cares about the small chart? That's one of the hardest things. Is saying to yourself, my large chart rules aren't met, I'm not even going to bother with the small chart. Because the small chart will talk you into some nonsense. It really will. That's why we focus on those key advantages first. That's why we say with the momentum and clear path, even just jumping in has a fighting chance. With momentum and the potential to break, you've got a fighting chance. And letting the large chart lead the way, man, it really does. Those core two advantages, they set you up for a better chance of being successful. Awesome questions. And one of the most common questions, Lonnie and everyone else in this room, is new users will do this. Hey, Mark, my rules aren't met. How do I get into the market here? Hey, Mark, my rules are, I don't have momentum or a clear path, and I don't really have an entry area. How do I make money here? And sometimes the answer has to be you don't. So termination, triggers roll, odds favorable, potential to break, waited for confirmation with the divergence, and quick profits again on the way up. Nicely done. Entered late, I know. Jen, I'm not even going to talk about your late entries anymore. That's how I know it's you. It's how I know it's you. You're killing it. And Jen, can I talk about this? Now I'm going to, because I had a lesson rattle in my brain here. All right. Bum, bum, bum. So let's do this. As a brand new user, I'm just going to talk about the entry. So I'm just going to go right here. And let's make this bigger so that you guys can see it. And I'm going to talk about it. And guys, in the very beginning, putting a buy limit order while the market's coming down is pretty terrifying. It really is. It's scary, not going to lie. So some people say, you know what, I'm going to let the market go in the direction of the trend. And then I'll enter. And what it does is they say, well, at least now it's going in the direction of the trend, and I know that my stop can go below it. And this creates a little security. It really does. It makes you feel better. And there's nothing wrong with that. There's nothing wrong with that. And that's okay, because it's terrifying. But the question is, from the correct entry to where the stop should, to where the market shouldn't go, very often, if the rules are met, if they're good, if they're in play, very often it's less risk to buy it on the way down. And that's one of the reasons why we teach this the way we do. And just because you wait for confirmation doesn't guarantee a win. It doesn't guarantee that the market's going to continue up. It doesn't guarantee. What it does is you have at least $120 risk on a confirmation bar. Because a 5-1 chart is 5 plus 2. It's a 12 tick bar, which means that if you're 2 ticks below it, you have like 120 to 140, almost guaranteed. So you typically, there's a cost for confirmation. And if that makes you feel better initially, I think it's great. I think do it, right? And especially with that split in the triggers, that's a great reason for confirmation, because the risk would be huge down here. But if the trade is perfect, guys, one of the reasons that we talk about study and developing trust and all that good stuff is when you trust the plan, when you trust entering on the pullback, when you accept the risk that it creates, very often it's less risk. But I understand that it's a little scary buying a market on the way down. And that's why, that's okay, Lonnie. I'll win. I always win. But that's why we talk about the idea, and let's see if we can find a good example here. The only thing I have up is I need to put up the S&P. Well, that was Jen's trade, and that was, I mean, that's a good one. I'm trying to find an example where if I get in at the pullback, has to be rules met. This is a good example. No, Wayne, I was waiting for you to get back, but I was going to get through a couple here, and I got you, though. So just hypothetically, guys, if all the rules were met, I could have this much risk initially, right? Getting in below at the area and the triggers, and it's virtually the same risk. If I wait for the confirmation bar, my risk goes up a little bit. Do you guys see that? I'll do it 2 colors. So there's the risk with a confirmation bar. And there's the risk buying at the area on the way in. It's about the same. Does everybody see that? In your head, you're saying, man, this is awesome. I have confirmation, I can move my stop, but you're not saving any risk. And this is assuming the trade is perfect. But what did you do? That's how much room I have to trouble. Here's how much I have from the correct entry. So if you're waiting for confirmation when you don't need confirmation, you're shortening the distance to your profit targets. Now, if you still have a ton of room, it's great, whatever. Just things to think about. So use confirmation bars if it makes you feel better. But learn and study and trust so that when it's not really necessary, you don't feel compelled to have that extracurricular risk on a trade. Thank you for posting that. And I know that it's true. I know that it's tough to buy or sell on the way down. Odds favorable, clear path, right at the area inside of triggers. Guys, his first target was where the confirmation bar printed. Morgan, this is a very timely picture. Do you see it? Odds favorable and clear path. Perfect entry. Minimal risk. Look where Morgan takes profits. Where you guys insisting on confirmation are getting in. He's already been paid. And he's already break even. And he's got all the room in the world to chicken out 2 ticks above support inside of favorable large triggers with odds favorable momentum. And should have let it run because nothing changed. I agree 100%. To the tick entry. Beautiful entry. And Morgan, this is the great. So Lonnie, if your brain wants to fight me, and it's okay, I love a good fight. Tell me what worries you, right? And let's work through it. Tell me what your fear is. Let's work through it. And you were punished instantly for that, Morgan. I agree. And Lonnie, I promise you, there is nothing you can tell me that I haven't done. There's nothing you can show me that I haven't done. There's no mistake you can make that I haven't done. And I've found a way to combat it. And I've found a way to work around it. Losing? So why do you fear losing? Ask yourself, what is it about losing that fears you, that scares you? Morgan, I like that you know why. Okay, lost some money. Let me come up with an analogy. Let's look at Boaz. Odds favorable, clear path, perfect entry, easy money. Boaz, this is beautiful. So Lonnie, the first thing you have to ask yourself is, can I afford to lose money? Can I afford to take a loss? If you can't, I think the answer is obvious. I never tell someone what to do or what not to do. But Lonnie, one of the things that you show me repeatedly is the high probability trim trade, right? So we'll use Boaz for an example. Because this is perfect. And he managed it so much better than Morgan. Just kidding, Morgan. I'm playing with you. All right, I'm going to put one word on this chart as soon as my stuff comes back. I'm going to put one word on this chart, guys. Trust. So Lonnie, this is Boaz's trade, right? Boaz, did you know you were going to win this trade? No, you didn't. Boaz, you were the wrong person to ask. Are you guaranteed to win? Because you follow the rules, guys. The answer is no. 80%, right? So Boaz, if you know that this pattern typically wins 80%, then you can say to yourself, I'm going to lose 20%. Every 10, I'll lose 2. Every 100, I'll lose 20. Do you accept it? That's the question. Do you accept losing 20% of your trades? Are you comfortable losing 20% of your trades? And this is for everybody in the room. Because here's the deal. If you lose 20% of your trades, doesn't that mean you're winning 80% of your trades? If you lose 30% of your trades, aren't you winning 70% of your trades? Guys, loss is a normal part of a positive equity curve. Loss is 100% normal. It's part of it. Loss happens. I take losers every day. Yesterday, my win percentage was 63%. 63%. That's not 70 to 80%. That's considerably lower. But what I know is that the pattern that I trade wins up to 70 to 80% of the time. I broke a rule yesterday. I made one mistake. And I trust that if I take the exact same trade every time, right? I was talking to someone about a trading plan yesterday, doing the same thing, having it written out, doing the same thing. So Lonnie, if I had a loaded coin and it landed on heads, guaranteed, right? You proved it, you flipped it 100 times, and you got 80% landed on heads because of the way I weighted that coin. Would you ever bet tails? If I said, Lonnie, let's go $100 a flip, would you ever bet tails if you knew that 80%, if you believed that 80%, if you trusted that 80% of the time you were going to win? I hope the answer is no. No. Trading is like that coin flip. This pattern, Boaz knows wins 70 to 80% of the time, which means that he accepts that he will lose 20 to 30% of the time. But if he can do this 80% of the time, is it okay losing that? So this is his win, 2 contracts, that's his loss. Is there any way, Boaz, to not make money if this is your ratio? It can't be done. Lonnie, this is how you eradicate fear from your trading, is you do the same thing every time. And the same thing that's been proven to win more than it loses. And the same thing that is testable. Do you see where he circled the tail? Look where it lined up, right at the area inside of triggers. So how do you get rid of fear? You have to believe in your plan, guys. And believing in your plan, it doesn't happen overnight. You got to study it. You got to look at it. But Lonnie, I'm so hell-bent on the perfect trend trade that if you have odds favorable and you have a clear path and you have the perfect entry, I would take that loser all day, every day. And it wouldn't even bother me. I would say something clever like, these guys have to come get me. They have to come get me 5 ticks outside of the triggers because this is the pattern that's been proven to win more than it loses. And I believe it so wholeheartedly that you will see losers in the spreadsheet when the pattern is correct. So Lonnie, you're still pretty new, brother. And you're developing that trust. And it's that trust that's going to help overcome fear. And I think that's one of the most important lessons. And Lonnie, part of that trust and part of that recognition, let me go back to it, is you become okay doing absolutely nothing if the rules aren't met. Does that make sense? And the bad news that I have for you, Lonnie, is congratulations, you're human. Everybody in this room goes through the same thing. Every trader goes through the same thing. because it sucks to lose. We've been taught our whole life that it sucks to lose. Kids don't grow up learning about acceptable losses. And we've got to learn that lesson as day traders. So thank you for mentioning that. And I hope that's helpful. And I hope that it sheds a little hope, because there's hope. And it comes from trust, man. And we're all getting there right now. System won't let you trade. I'm not sure, Marky Mark. You would want to talk to your broker. It takes a while, Lonnie. It really does. You'd want to talk to your broker. I don't know what you have available. I do know that you're trading directly into termination conditions without momentum. So maybe they did you a favor. But you'd want to call your broker and see what's going on. I know you had that yesterday. You were talking about it. And Lonnie, I think you're doing all right. That hadn't printed yet, so you had odds favorable, and you had a clear path. And look at where you bought it, and look how easy it was to make money. Just call them. Pick up the phone, Marky Mark, and call them. And don't hang up until they explain to you what it's going to take to get you live. I don't know. Who did you talk to fund the account? No, because Pete, it's not funded. It's not a prop firm. It's a live funded account. So there you go. GTS. I call. I think people use emails too much. Pick up a phone, make it ring, force them to talk to you. And then Lonnie, it's beautiful, isn't it? And because of your great entry, you are out where you would have gotten in with confirmation. You're building trust. You know where your stops go. You know the rules. You're just learning to trust it now. Dude, this is such a great trade. This is the trade that I take. And this is the trade that I go to the spreadsheet. And this is the trade that we call it Lonnie's perfect high probability trend trade long. And you should do the same thing, because when it's perfect, that's how you'll develop trust. Good stuff. Joel, odds favorable, JTFI because of momentum on both charts. Out at the fib. Nice one, Joel. Pete, everything says up, clear path, just jump in. Lonnie, that's your momentum. Momentum on both charts. Jump in. When momentum goes away, exit. Both of you. Great job on that one. Fire. 63.90. All right. Man, I love that you're posting, Fire. We're going to get there now. So the only thing that I can't see here is what's going on your large chart. It's just Google. So Faya, one of the things you can do is you can click this black arrow and it'll get you to the most current bar. See how this market looks like it's at 63.75, but here it's at 63.94. So I want to talk about what you did. And I don't know why you did what you did, because you didn't tell me. So let's get into the habit of writing on a chart. But what you've got is everything apparently says up. You did hit trouble, and this is problematic. And this is an area that could stop the market. And I know that it's on your large chart as well. And you don't have an area inside of those triggers for entry, but this market's screaming, and you take the bounce, and you make money. And it's all trading with the large chart. It's trading with that momentum and going up. And then the next picture is exactly the same. So that was crude oil right at 10.22. Dun, dun, dun. So we're going to take a look at it. Oops. Crude oil 1022. I didn't have that area. This looks different. Was that from today or was that yesterday, Faya? Hope they get you all squared away, Marky Mark. Because mine looks very different at 1022. Oh, there it is. We're in different time zones. I got it. So here we go. So Faya. Now we can see both sides of your chart. And the first thing I always look at is momentum. And I ask myself, do I have strong triggers? And the answer here is no, because the small are inside of the large. Strong triggers is always strong triggers, and it looks like this. It's that separation. And this is where you'll learn to trust the advantage that the software provides. This is an area that could stop the market, could create a bounce. There it is right there. There it is a second time. And you know about this big fat red line, and it's okay to say to yourself, you know what? I don't have any momentum to push through it, and price has reached the area, my triggers are below, and this would be one of those times where you can't really find a rule met. And do you see how, and Faya, I hope you're listening, because what we're doing now is we're identifying the advantages of having a plan of the software. Do you see how in this one bar, there's all this fight right at that key area? This is what the software does for you. That market has been going up for an hour. And where did it bounce? Right at the key Fibonacci area. And guys, rule number 2 is designed to say, hey, this is where all that momentum is likely to take it, but this is where it's likely to stop as well. So if you found an entry, this is a beautiful target. And now we're in a little bit of a patient zone, just a little bit of a, man, let's get to the other side of it. And if we get to the other side of it, we'll look for opportunity again. Because this big fat red line is precisely where the men and women who move the market are likely to reverse, to fight, to create problems that mess up your good time. Does that make sense, Faya? I love it. You're going up with the trend. You're looking for that long trade. You're dying to buy the market, which means you're already eliminating one of the biggest mistakes most people that trade the markets are making. And now we'll use the rules, the methodology, the things that Nexgen's been teaching for the last 30 years to keep you out of a little bit of trouble, to make you not have to hope, and to give you the highest chance of success as you learn to read these indicators. So thank you for posting. I know you're new, and I know it's scary to put that first one in there. Good stuff. All right, guys. I'm going to take 2 minutes. Wayne, when I come back, we're going to go to your charts and go through all of them. And I haven't even looked at them, so I don't even know what to expect. What kind of craziness coming from you. Guys, I'll be back in about 3 minutes, maybe 2 minutes. And then when I come back, it's going to be the Wayne Show. I'll get it set up. But I'll leave you guys with the live market. We'll see if that market stops things. All right, guys, I will be back in just a moment. I guess I should mute this. I love it when you guys keep me so busy that we get to the end of the day like this. So, all right, Wayne. Chili dog fail. Well, you forgot the most important part of the chili dog, Wayne, is the momentum on the large chart. And man, if those triggers are flat, if they're not open, if they're not wide, you just don't have momentum. Yeah, and those printed just before. But does that make sense, Wayne? That's your chili dog look, right? This is that, oh my gosh, it's a little harder look. Small chart looked great though. Small chart tried to talk you into it. And then there we go. With that momentum and clear path, it's just easy. And your triggers look weird. You need to reload historical data. But that's the one. For you guys that want momentum trades, Wayne just gave you the template. Wayne gave you the template. Odds favorable, odds favorable, odds favorable. My goodness, it's hard to stop a market when everything is screaming in the same direction. There's nothing in the way. Strong top, 50-50. You get the pullback, but you catch it on the way down. I like it. And because you know where the market's likely to go with the momentum, easy profits. This is nice. So Lonnie and you guys that love confirmation, Wayne has kind of cut confirmation in half. He knows where his area is, and he lets the market go through it a little bit, and then he catches it on the way down. And if it bounces right off of it, he's going to miss it. But this is one of the ways where he gets in a little bit before confirmation because everything is lining up, and that's a great trade, Wayne. And then momentum, it's kind of a 50-50. You don't get in on the pullback because it's on the wrong side of everything. So when the small triggers roll, that's an awesome continuation entry. And then nice profits. This is a great example of when the large chart says, okay, we're most likely to go up, but your small chart isn't really agreeing. Wayne lets those small triggers roll around, and you'll notice at the time of his trade, every indicator on every chart agrees. Every indicator says up, and he just goes up with it. And nicely done, dude. Heartburn trade. Potential to break. Right at a fib. Outer band. And Wayne goes counter trade. And he doesn't hope for home runs on this one. He says, all right, this one only has the potential. It's not a strong top. I'm extended. Nice job trading back to it. Sitting in bed trading. Another one of your heartburn trades. This one fights everything. Yeah. Oh no, that's your exit. Okay. Everything says up, you jump in, you get out when you lose momentum. Nicely done. Joel, it is okay to put these trades in earlier. I just want to say that. I know most of them are market replay. It's all right to get them in the room earlier. Once again, everything is up. And instead of hoping the mid-band holds on the wrong side of the triggers, you get in on the way up. Nicely done, Wayne. I think you've got your groove, man. Oh, heartburn. Using the termination, and you're just saying, you know what? I hope it holds, and it does, and I'm going to get out at an area that could create a bounce up. Nice trading, Wayne. One more. Everything's up, nothing's in the way. You just jump in and make money. Nicely done, Wayne. And I don't know if Trina told you, but I beat you to it. Got my Kaizen tattoo last week. All right. Oops. Boaz, let's get you here. Same thing as the other way. Everything says down, the momentum is great, the entry is well defined, and the profits are easy. Boaz, you are one of the most boring traders ever. Momentum path, perfect entry. Momentum path, perfect entry. Take an entry, make some money. Just outstanding. Same thing. Guys, said it when we talk about a trading plan. It describes a pattern. You can prove that it wins more than it loses. Trading is boring if you're doing it right. All right, that's 20 of them, Joel. Let's see what we have. Triggers roll to the upside, not the fibs. You let the small chart show change where the large chart shows potential, and it's easy. Nice one, Joel. Odds favorable. You fight the triggers and lose. And then when everything's going the same direction, it's easy. Isn't that crazy? Joel, try to go short because of a red line, get stopped out. Everything says up and it goes up. Everything says down and it goes down. Hit the termination instead of just jumping in. Nope, trading directly into a termination with no momentum and you lose. And then everything says up on this chart and it's an easy win. Is this practice after our conversation? Odds favorable. But you have the termination and you force the small chart to confirm and out at trouble. Very nice. Everything's up. You're going up with it. I mean, my goodness, Joel, we found your boogie, man. Instead of hoping it holds, you let the small chart, nope, you went short. Fought triggers. Fought triggers. There we go. So, Joel, ask yourself, when I fight triggers, do I win more or lose more? Guys, this is how trading plans are built. When I fight triggers, you lose more. Watch this. Hold on. Fought triggers and lost. Fought triggers and lost. Went with the triggers and won. Fought the triggers and lost. Do you see the pattern? Guys, this is how you get to where you want to be. Odds favorable, nothing in the way. It's easy to win. I love that one. Beautiful entry. Everything says down, you go down with it. Everything says down, you go down with it. And this is one of the problems with that big chart, is everything says down, but they're giving you those huge fluctuations. Nice job protecting your position. And then once they roll, it's easy money. Great job, Joel. Everything says up, you go up with it. Everything says down, you go down with it. You get down to trouble, and then here's one of the challenges, right? Directly into a termination condition. And Joel, it's okay to respect these because this is still a huge chart. That's a real thing. And do you notice the gap theory here? See how the large triggers are a full bar away, Joel? Let me know that you see that. That says no short trades. So avoidable loss. And then it comes up and you get the 50-50 and it doesn't work. And your termination here identifies that. You take your entry. You could have added more, or you just hold the trade and make money. Nicely done. Everything says up, and you go up. You fought the triggers and you lost. Weird. And then you get the termination and you go short and it works. And then everything says up and you go up with it and it works. Triggers roll after breaking the fibs. Bad top though. But you don't know about divergence until 3 bars down. You take the long when everything says up. With the weakness, you don't lose. And then all that weakness, you let it roll over here, and it's just easy. And Joel, I want you to avoid that should've. I should have added on. I should have held longer. I should have done this. Guys, that's how you set your brain up to think you're failing when you're not. Look at your trade. And let's do some math real quick. You're in at 76, you're out at 68. So 8 points, $200, 73.50, that's 5. I don't know. How much do you suppose you made on this trade, Joel? $1,000? Maybe the 2 lot, 600. So what if you take that one 4 times a day, right? How are you going to add on here? You could have, but you're in the middle of managing a trade. Like, celebrate. A $600 trade, for most humans, Joel, that's a daily goal met. And remember, you're learning to be consistent, right? Odds favorable up, you go short. Odds favorable up, you go short. Why? Why go short when it's strong against you? You don't have a reason to go short here. Mid-band's not a termination. Odds favorable up. Odds favorable up. Small's above the large. There's no shorts to be had. And then finally with the termination, small trigger rolls, it's easy, right? How many do you have to eliminate so that these can pay the bills? And that's it. That's your thing. Guys, one of the great things about posting in this room is everybody has a thing. Everybody has something that they break. And Joel, every time you fight large triggers on the large chart, you take a little bit of a beating. That's the recipe for financial suicide. So I'm going to give you the John Novak statement, Joel. I had to hear this, so I like to share it. How many times are you going to get your ass kicked doing this before you get sick of getting your ass kicked, right? It's trading in determinations, it's fighting triggers, it's all those things that we all do, Joel. And there's a point where it clicks. There's a point where you say to yourself, you know what? I'm all right waiting 3.5 minutes. I'm all right waiting 3.5 minutes for the right trade instead of hoping I can be the first person in. Your plan is solid. When it looks like this, go with it. When it looks like this, stop fighting it. Loser, winner. Crazy. I love it. So much great study. When everything is down and clear, you make easy money. When everything is up and clear, you make easy money. When everything is strong down, you hope. And this time you got paid. But why bother? Why bother going long? You hope the midband would hold. The gap theory works. Great patience waiting for the reversal bar. Trade it back to the gap. It's nicely done, but that's where you're making money. Reversal bar, correct side of the triggers, easy. I like it. We've got your pattern, Joel. Now it's just trust. Everything says up. You go long. You don't wait for the reversal bar on the correct side of the triggers. And then once you get it, it's easy. Do you see it, Joel? This is the one that we talked about. I hope it goes up. It's confirming that it's going up. As long as I'm on the wrong side of these triggers, you're fighting odds favorable momentum. You're hoping that an area holds. Once you get to the other side, man, it's easy trading with that large chart. Got ran over. You did. Your small chart confirms the large chart look. And once you got it here, it was so easy. Great job, dude. Once again, momentum everywhere, path. It's easy. Momentum, path. You try to go long. I like it. Just doesn't work. Nothing wrong with that. And then when it turns and gives you what you're looking for, it's easy. That's great stuff. Joel, I know I went through them a little quick. If you have questions, let me know. But it's because we've figured out your thing, brother. And that's one of the perks of this classroom is, Joel, you need a piece of paper on your desktop that says don't fight strong triggers. And if that's the only change you make, is you eliminate that trade where you fight strong triggers, it's going to knock a lot of losers out of the equation. Pretty cool. I love when you guys do that level of study. I love it when you post 20 pictures in the room. I'll go through them a little quicker, but I guarantee we'll find your wins. We'll find what makes sense, what gives you the highest chance of success. You're welcome, Joel. I am nothing but